Hi, Chad. Thanks so much for joining us today.
Thank you. Appreciate it. Looking forward to getting started and reviewing everything with everyone. Thank you. Alrighty, thank you again. Let's start into some of the slides now. I'm going to get my screen fired up for everyone here, and we can get into this. So the presentation I'm going to walk through today is similar to the presentation that I used down in Dallas. We're going to build on it, though. We're going to use a lot of the same talking points, but we're also going to go through some more detailed questions as we walk through this and towards the ends of the presentation. But a lot of these topics are what I call foundational topics. Whether you're in your early training years or in your early attending years, a lot of these are foundational to that phase of your career. And I could even argue later in your career, but we probably have to change the context a little bit. So I'm going to really push this one more towards, anywhere from, hey, my intern year as a resident, maybe those fellowship years, or all the way out to, a couple years, even up to 10 years as an attending. I think a lot of these topics hold a lot of power and ground to. So without further ado, let me get fired up here and we can get into this. So the main items we want to start with are going to be financial wellness, student loans, investing basics, risk management, and then, like I said, we'll save some questions at the end. We already have a good lineup of questions coming your way. So financial wellness is probably one of the largest topics in terms of general financial planning, right? As you can see here, it covers a lot. This could be the questions on how much home can I afford? Should I build a budget? You should. What does cash flow look like? What's too much home? Do I have too many student loans? Hey, I've been dying to get that Porsche now that I'm attending physician. Does it work? These are where the magic happens. These topics are where that foundation is being built. So the first one I want to get into is cash flow and budgeting. We'll touch on emergency fund. We'll touch on what I call the gap months. Now, the gap months are very important for those of you transitioning between your training years and actually starting as an attending. So I won't spend too much time there, but I do want to cover some main ideas to keep in mind. And then another great topic is the physician mortgage, which that one does cover that entire span that I noted earlier, all the way in those training years, all the way out to 10 years as an attending. So cash flow and budgeting, it's not the most exciting topic. I get it. No one's excited to budget. At least most are, right? Some are excited to budget. But one of the things you need to master early on in your paycheck days, right? I always say coming out of medical school, I'll always vouch for you all that you're not paid enough in those training years, but you are getting paid good income, right? And this is where building the foundation, getting things organized is so vital, not only today, but as you go forward. A lot of the habits you build now are going to be habits that you can carry with you going forward. So when it comes to cash flow and budgeting, the main thing I just want you to get comfortable with is just tracking, right? Track money in, track money out. You can go old school here. You can use a pen and paper. We like to use technology. I think technology makes it more repeatable. It's not as intensive. Some of our favorite budgeting software includes Monarch, which is one of our newer additions that we really like. YNAB, which stands for You Need a Budget, is another popular one. And another one that we like is Tiller. Personally, I used to use Tiller a lot. Then I was introduced to Monarch more recently. We also introduced some clients to Monarch more recently. And Monarch and Tiller, similar idea of how your traditional budget, right, kind of lists it out, build it out, money in, money out, where YNAB is a little bit more unique in terms of YNAB is trying to get you to think of terms of paying forward. So if you have X amount of dollars in your emergency fund, they might come in and say like, hey, you've pre-funded 3 months of budgeting. So just a little bit different way of looking at things, to each their own. I'm a bigger fan of that Monarch and Tiller side of it, or what I would call more traditional budgeting, where YNAB can really stick with a lot of people, and they really enjoy that one as well. So regardless, look for something that you can be comfortable with, because the key to budgeting is you have to be able to come back and do it, right? And maybe it is an Excel sheet. Maybe it's just something simple like that. Or maybe you keep a notebook where you're keeping big items in there. But get comfortable with budgeting and cash flow. I cannot emphasize enough how important it is, not only today, but as you go forward as well. So continue to build around that budget. Continue to build around there. And, another common question we'll get here is, how much? How often, right? How often should I be doing this? If not to say that I have this all figured out, I personally like monthly. Monthly is good for me where I'll get in there and update some things. Maybe every now and then I'll jump into the Monarch app and I'll at least categorize some things ahead of time. But even there, you might say monthly is too much. If you could get into a quarterly habit, still a win. Semi-annual, you got a lot of transactions to review. Annual, again, a lot of transactions to review. But I don't really care what interval you're doing it. Just get used to doing it. And that'll put you very far ahead of most, because most don't do this. So cash flow and budgeting, one of those early things to conquer. In terms of the emergency fund, right, that rainy day fund, first thing I want you to think about here is a high yield savings account. There was a recent report that came out that said still over 80% of Americans are not utilizing a high yield savings account, which is insane saying that today, because a lot of these high yield savings are anywhere from 4 to 5% interest rates. Now that rate does change, right? So depending on when you're watching this, that rate could be different. But very good online banks include Ally Bank, Marcus, which is owned by Goldman Sachs. Sometimes people like that bigger bank behind it. Capital One has great online savings. American Express has great online savings. But right now, you're looking for those higher rates. And the reason why we call them high yield savings is, unfortunately, your larger banks, or what I say, the banks that have brick and mortar locations are likely not anywhere close to those numbers. So the first thing you need to keep in mind for the emergency fund is just making sure you're parking that money in a high yield savings account. Now, in terms of how much, now, I think this one really depends on, are you still in training? Are you an attending? If you're still in training, I'll always say, if you can leave training with a couple thousand, maybe that's 2,000, 3,000, 5,000. If you can push it higher, 10,000. I realize that's hard to do, especially depending on what part of the country you're doing your training in. As I always say, if you're doing your training in New York City compared to Iowa, the cost of living everything is more expensive in New York City versus in Iowa, or already any more of the rural areas. So that has a big effect on it, right? So anywhere from a couple $1,000s, chalk that up as a win. Now, if you can't do that, it's okay. It is okay. Don't let any of the topics that I walk through today, if you sit there and you're like, I don't have that, I haven't done that, it's okay. That's why we do these presentations, right? We're trying to give you the foundation that you need to go forward. So even if you leave training and you have nothing put away, it's okay. Prioritize this as something as you go forward. As soon as you get that first big kid attending paycheck, put some money into that emergency fund and really build it in a consistent habit. Now, as we transition into those attending years, we can add a little bit more structure to this. And even there, we still build it out over time. But ideally, the one that we use, we're a little bit more aggressive. Now, we traditionally do work with younger clients. And when we say younger in the financial planning world, that really means anyone under the age of 60 is still considered young in terms of working with a financial planner. So our clients are usually in the first, 10, 15, maybe 20 years as an attending. So we're still in that period of life where there's a lot of curveballs that can occur. And that's why we do take a little bit more aggressive stance where we'll use 6 months of net income. So think of what your pay stub says. You got to pay Uncle Sam and the crew, right? And then that number that comes in after that. So before your deductions for like the 401k, disability, things of that nature, we like to take that by 6. So it's not perfect. It ends up being a little bit more aggressive number, but we also like to sprinkle in maybe utilizing one of those high yield savings, but then maybe also dabbling in a investment brokerage account, whether that's an individual account or a joint account. So we do split it up a little bit because you got to be careful. You don't want to have too much in cash. You don't want to hurt your long-term planner or miss out on that opportunity cost. But we usually like to come to our clients with a question of what's your sleep number, right? What is the number that you need to sign on to your online bank, see it, and you go, feels good. Even if crazy things happen, we are in a really good spot here. And we work with physicians, right? The numbers are higher. There's higher income. So I usually will say at a minimum, we usually don't ever want to see our clients below $20,000. Clients will say that number feels high, and we'll still say, just trust us. Use that 20,000 number. It's a safe number. Usually it's the opposite though. Clients will say they want a higher number. 50,000 is a very consistent interval. 100,000 is a very consistent interval. Now it depends on your household situation too, right? If you're watching this as a sole provider and it's just you, your numbers might not be that high because it's only your income. If you're in a dual physician household, that number can get higher a lot quicker, right? So just keep that in mind when you're walking through those numbers. But whatever the number is, just make sure you truly carve out an emergency fund. Don't let it get blended in there with your checking account. We all know what happens when it sits in your checking account too long, right? you spend it. We all do it. We get it. So make sure that you're building that out as that true emergency fund. The gap months, I won't spend too much time here depending on where you're watching this. If you're an attending physician, go grab a water, head to the bathroom break here, whatever you got to do, take a second. But if you're watching this and you're still in your training years, this is that period of time from when you will stop your training and before you start as an attending. Now, for some of you, I know that could just be a couple weeks. It might be a couple days. You could literally finish up training and then boom, you're starting it. It depends on what that is. But if it's a longer period of time, just keep in mind that you don't have income for that period of time, right? So anything you need to survive off of, just your overall budget. I would say health insurance is a big one here, right? Are you going to go on COBRA? Are you going to go get some type of short-term health insurance? It's expensive. Hey, if you finish up training in New York, but now your first attending gig is in California, it also costs money to move across the country. So just keep in mind a lot of these moving parts. And if you do know you want to keep a larger gap months, or you're saying, you know what, I just worked my butt off for how many years now, and I'm just going right back into it. I'm going to take a month. I'm going to do some travel, build up for that travel, right? We don't want to come into either attending. You're like, whoops, got 30 grand in credit card debt, but I did tour the world. Just make sure you're pre-planning to the best that you can, putting money aside, but then also preparing from a budgeting perspective for those. Like I said, it's one of those unique situations where it affects some and others don't have any effect, but those larger gaps can become an issue. So just keep an eye on that. Another popular topic, I can tell you this is a popular topic because on our YouTube channel, this and backdoor routes, which we'll get to in a bit here, and 457B, sadly enough, which we'll dabble in that one. Won't get too much into that today. The physician mortgage is a very popular topic. Both we see it on our blog and our YouTube channel. It's also one that we get a lot of questions on. A physician mortgage. It's a mortgage that is specifically designed for you because the banks will sit there and say, hey, you're a doctor. We know you're going to make good money. And because of that, we're going to give you access to this special mortgage. And the beauty of the physician mortgage is, depending on the price of the home, that's also very important, it could be as low as a 0% down payment. And then it doesn't include something called PMI, or what we call private mortgage insurance. For the most part, I usually say PMI is usually a couple $100 per month, depending on the price of the home. We see anywhere from $100 to $300 per month. If you maybe would get a conventional mortgage, which is not a physician mortgage, but a conventional mortgage can be as low as a 5% down payment. But if you don't get above 20%, you have that PMI on there. Now, just because this has your name on it doesn't mean this should be the only mortgage you're looking at. And what we like to do is compare the options, right? You always have this physician mortgage. What's the rate of the physician mortgage? What's the conventional mortgage look like? What's the rate of the conventional mortgage? Even if you can't get 20% down and we have PMI or private mortgage insurance, it does fall off. It will fall off when it hits 20%. So if we get a decently lower rate on the conventional mortgage, we might go for that. We might like that because while a 0.5% might not seem like a lot on a $500,000 or $750,000 home, or maybe more depending on where you're living, this is a large number. So we're okay paying a couple $100 per month for a few more years until that PMI falls off if it's going to save us, $50,000 or $100,000 in the long run based on the total interest cost. And speaking of interest, again, depends on where you're watching this, but a few years ago, you could lock in a 30-year mortgage for 3%. Today, that's like between 7 and 8%. So not only are the overall costs higher, well, now that 0% down payment on a physician mortgage doesn't also look that attractive, right? You don't want to go into it, one of the largest, if not the largest purchase of your life, at an 8% interest rate and say, I'm not going to put anything down. Now, for some of you, that might be the only way, right? And there's a whole deeper conversation to have there. But with rates where they are today, and who knows where they'll be going forward, physician mortgages, not to say that they're not attractive, they still are attractive, just that 0% down payment is not nearly as attractive. And some numbers to keep in mind, every bank will be different. Every lender will be different. This is the most common numbers we see. Homes, or I should say mortgages, depending on what you put on as down payment. So let's just say the mortgaged amount. The mortgage amount under $750,000, most lenders, true 0%. So nothing down on those loans. Now, some lenders may need something, but for most, we've seen 0% down up to $750,000. Above $750,000, up to what we usually see at about $1.25, they usually will ask for a 5% down payment. So I emphasize this because Physician Mortgage, while the headline, the clickbait per se, right, is that 0% down. If you're looking at higher priced homes, it's not 0% down anymore. And if you're going above 1.25 million, be careful, right? It could be as high as 10%. So they could be asking for 10% down. Now, just because that's the number, you can still put more down than that. So also keep that in mind. You could say, hey, I like this Physician Mortgage. The rate was lower than conventional mortgage. It's telling me I only have to put down 5, but you know what? I'm actually going to put down 10, or I'm going to put down a little bit more. When rates are as high as they are right now, which again, this can change relatively quickly, we are bigger fans of larger down payments because it's 7-8%. That's a pretty expensive number. So Physician Mortgage, a great tool to have in your back pocket. Many of you may utilize it, but just be aware that just because it has your name on it does not mean that it's perfect for you. And make sure that you are keeping an eye on it compared to that conventional mortgage as well. So financial wellness, main things you're trying to keep in mind here are just building that foundation, right? Getting your cash flow and your budget organized, building up that emergency fund. If you're going to have gap months, prepare for those. And then when we get into that home buying, that Physician Mortgage, and even on the home buying, just one more thing to add in there. If you're watching this and you just got your attending gig and you're about to move somewhere new, we are bigger fans of renting for a period of time. We're pretty big fans of renting in your training. I know there are some stories there where, hey, my best friend bought their home as an intern and they just doubled it, 3 years, 4 years later. And, why can't I do that? And there are those situations out there, but they're not all that common. And even when you are in that attending phase, we usually like to say, hey, rent for a little bit, find the area, find the neighborhoods that you like, make sure that you like all the partners in your practice or all the other physicians at the hospital. When you sign on that dotted line the first time, it always feels like everything's going to be great. But unfortunately, we know things can change. So it's not a bad idea to maybe rent out of the gate. Maybe it's not a full year, right? Maybe do something shorter term, a 3 or a 6 month, just to kind of get your feet on the ground and find out the area. Now, if you're already been in that area for your training or that's where you grew up, maybe you do know more about the area. So just keep that in mind. They're just a little bit more food for thought. So let's keep this going. Student loans. Again, this topic is going to probably have different levels of engagement depending on where you are in your current physician path here, right? Are you still in your training? This is probably a big part of a lot of your decisions. If you're already an attending physician that has paid off their loans, or maybe you already got public service loan forgiveness, this might not be that vital. But as you all know, student loans in the physician world are one of the more popular topics based on the amount of debt that you all have to take on to become a world-class physician, which is a whole nother conversation, right? We could go down a whole nother rabbit hole on why there are so many things wrong with that statement, on why you do have to take out this amount of debt to become a physician. But hey, that's a whole nother conversation for a different day. So, from our side of it, half the battle right away is knowing, do you have a chance for public service loan forgiveness, or are you going to go for aggressive payoff? When you have more unique specialties like urology, I would say that one of the benefits there is while you're training longer, it is a lot easier to get you much closer to PSLF, public service loan forgiveness. I'll probably say PSLF a few times, but that's just short for public service loan forgiveness. So if you're getting, 5-6 years out of training, well, now you may only have to be at a nonprofit hospital for, 4 or 5 years. So that does help on specialties that have a little bit longer training path to them. So the longer you know that, or the sooner you know that, the better. If you are going to go for public service loan forgiveness, and honestly, I would really argue this for anyone, whether you know you're going for PSLF or not, forbearance is not a good option anymore. So if you're watching this earlier in your training, let's just say that intern year, forbearance used to be one of the better options before income-driven payment plans. With income-driven payment plans, especially in that first year, assuming you didn't have much income or maybe some low side income in that last year of medical school, your income should be so low that your payment's probably zero. So you can start to accumulate public service loan credits. And if this topic is new to you, the key to public service loan forgiveness is 120 payments. 120 is the key there to get public service loan forgiveness. The beauty of public service loan forgiveness, not only is the debt forgiven, it's completely tax-free. where traditional forgiveness, which is very hard for a lot of physicians, maybe some specialties that took on a ton of debt. We usually see this more on the dental side, like general dentists, general vets, where they might be to go for traditional forgiveness. Downside there is it's taxable, so it kind of creates this giant tax bomb. So public service loan forgiveness, if you're going to go for it, even if you're not going to go for it, I would really argue skipping forbearance, starting your payments as soon as possible. Don't even take that 6-month grace period. Just get fired up there. Public service loan forgiveness needs that 120. So the more you can get at a lower number, ideally 0 in this case, the better. Every situation is unique, but SAVE is usually the best plan going forward. Now, SAVE is the new one. If you are a student loan nerd, I hope you're not, but if you are, that is the one that replaced Repay. So now we have SAVE. Down below, though, we have this note. If you make more than you owe and you're currently on track for forgiveness, IBR or Pay could be a better option. And the main reason there is because you're going to have the payment cap. So IDR and Pay are ideal. Now, at the time of this recording, I can tell you that we are about a month away from when you can no longer enroll into Pay. So the one that says PAYE, which has been a fantastic plan. It's actually probably one of our most used plans for our current clients. That one is headed out the door. Now, if you're already in Pay and you're watching this video and you're thinking, oh no, you're good, you're safe there. But no one will be to come into that after July of 2024 if you're watching this at a later date. IBR will still be around. IBR is not as attractive as Pay, but still has that payment cap. So just keep that in mind. If you have private loans, private student loans are usually the easier one to refinance, right? Because we're not worried about missing out on anything. Federal loans, you got to be extremely, extremely careful. If you refinance those to a private loan, any type of public service loan forgiveness, traditional forgiveness, throw it out the window. It's gone. So you got to be very careful with federal loans. Don't do anything you're going to regret. Private loans, refinance as much as you want. It's not like a mortgage per se. You can go refinance these things and there's no new closing costs, right? It's not these crazy numbers. And that's why you can actually, we'll have clients that will refinance, quite a bit. Now, where rates are today, the rate you have currently is likely lower unless you haven't refinanced from the day you took those loans out. There it might be a little bit lower. But make sure you read the promissory note. Understand what happens with a premature death. Understand what happens with a disability. Be very careful having someone co-sign. Co-signing is very dangerous because if you do have a premature death, that person that co-signed could still be on the hook for those student loans. If you have a disability, they could still be on the hook to pay those loans even though you can't earn an income anymore. You're earning a lot less income. So that is one you have to keep an eye on. So just be careful with those private loans. This last bullet point I have on here, we could go back just a few years ago, we still had quite a few conversations with physicians where they were concerned that, are we sure public service loan forgiveness works? And I think now the writing's better on the wall that it does work. It should continue to work. We're not concerned about that. So you're going to continue to probably see more and more of your peers getting public service loan forgiveness. The last one on here, this is a popular topic. This is one that during our live presentation, we use this neat technology called Slido. So all the physicians in the audience can send questions and we cover them at the end. So for now, don't worry about that. But if you have questions, make sure you get them over to us. We're happy to help you walk through those as well. And like I said, we'll already have some questions waiting at the end as well from some other questions that we had from some other physicians. Okay, so let's get into Investing 101 now. And this is one of those topics where, again, it really depends on where you are in your career. I know I've said that a few times here, but it's a dramatically different answer to, hey, I'm in my training compared to I'm a fifth-year attending physician, right? I usually will describe it in your training years. You're just trying to dabble, right? You just want to start to get your toe in the water. Maybe that's getting the match from the employer plan. Maybe that's starting to get money into a Roth IRA. By the time you're an attending physician, and I would argue very early, like first year early as an attending physician, we want to be doing a lot more than dabbling at that point, right? We want to be taking bigger chunks per se. A lot of times what I'll say for my attending physicians, probably maxing out the 401k, 403b, probably doing a backdoor Roth IRA, no questions asked, and you're likely even doing more than that, right? Maybe it's putting into that taxable brokerage account. Maybe if you have the kiddos, right, you're on the 529 plans. Maybe you're putting more into cash savings for other goals. there's a lot more than just dabbling. So let's kind of walk through high level some things to keep in mind here, and I'll try to kind of give you training context versus early attending context as well. But most commonly, you're going to see employer plans, right? This is going to be likely your first place to start. This is where you're going to see 401ks, usually in the private sector. You're going to see 403bs, usually in the academic side of things. 457bs, you can see on both sides. Here is the tricky part with 457b plans, and I know I joked about this earlier, but this is also why this topic does pretty good on YouTube, is there's a lot of questions about it because there's technically two different 457b plans. There is one, which we call a government 457b plan, and there's one that we call a non-government 457b plan. A government 457b plan pretty much acts as a 403b plan. It's really a bonus 403b account, or even, a 401k. In that example, if you put money into it, it's always your money, right? So whether you leave, and now there's a vesting schedule, and if there's pretty match, that the main point of this conversation, but if you're putting money in there, it's going to be yours, right? You're going to get to it one way or another. With all these plans, your money is always your money. So whatever you put in from your paycheck is always yours. But if the employer is putting money in, which is pretty common, right? We want to see employers putting money into the 401ks, 403bs. There's usually something called a vest schedule or a vesting schedule. And that means that if you're not with them for a certain period of time, all that money that they put into it may not be yours, right? So if you work at a hospital for 2 years, they put 10 grand of matching money in there, but the vesting schedule was only at 50% 2 years into it, you only get to take 5 grand of that with you. So just keep that in mind, something called a vesting schedule. But coming back to the main point here, a government 457b plan, the money is always yours. The opposite side of that, non-government 457b plan. Here's where it gets a little bit concerning. On a non-government 457b plan, the money is technically not yours. So what could happen in this situation? Well, if your employer would go bankrupt, you could lose all that money, even the money you put into it. So that's why you got to be careful with these non-government 457b plans, right? The money is not always yours. Another thing to keep an eye on with non-government 457b plans, check what the withdrawal rules are. So let's just say the hospital never goes out, right? Your practice never goes out of business. That's a good thing. What can you do if you separate from service, right? What are your rollover options? And some of these plans have very strict rollover rules that'll say, hey, you can't roll it over anywhere. And by the way, you need to pull all the money out by April of next year or 1 year from now. We'll have these strict rules in there where usually you're looking for, hey, you can delay until 65, and then at 65, you can spread it out over 10 years or some type of variation of that. But why could this be problematic? Well, if you're in the middle of your career or early in your career and you're in high earning years, all of a sudden you put 100 grand in this 457b plan over the past 4 years, you separate from service and they say, hey, surprise, Dr. Smith, you got to pull all that money out next April. Well, you're already making good money, and now you got to pull all this money out. Remember, it's all pre-tax dollars, and it's added on top of your current income. So it just increases your AGI, your adjusted gross income. So that can also be dangerous. Luckily, we've seen the non-government 457b plans get more and more flexible with that. But still, something to keep in mind, government 457b plan, you're okay. Non-government 457b plan, just, again, read the fine print, make sure you understand all the moving parts of that. If you're in training, ideally, if they have a match, and I know, unfortunately, not all training programs have a match, but if they do have a match, at least get the match dollars. And what a match is, it might say, Dr. Smith, if you are going to put in 3% of your salary, we'll match it up to 100%, up to 3%. So you put in 3%, we're also going to put in 3%. That is what you're looking for in terms of taking advantage of the match dollars. Because for all intents and purposes, that 3% is free money. This is where we say the match is free money. So keep an eye on that. At least get that amount and take advantage of that free money, that match. Now, if they don't offer a match, I still like employer plans because they're simple, but I'd likely start to look maybe towards, hey, if you can't get a match in there, maybe you start to do just a Roth IRA. Now, I put some income limits down there. Usually in your training years, it's not a problem, right? We usually don't see training programs paying out more than 150 or 146, right? That'd be a nice problem to have. That's probably still lower than what you should be paid, but again, another conversation for another day. But those numbers are important because once you go through those thresholds, you can no longer save directly to a Roth. This is where that really cool term backdoor Roth IRA, if you read any of the physician blogs out there, right, that's one of the more popular investment vehicles out there. And keep in mind, there's no such account as a backdoor Roth IRA, right? You can't just go to Fidelity or Vanguard and say, hey, let me get one of those backdoor Roth IRAs. You're opening up a traditional IRA, putting the money into there as a non-deductible contribution, converting that over to your Roth, and that little move from the IRA to the Roth, that's where we get that term, the backdoor Roth. Things to keep in mind with the backdoor Roth, so this is probably leaning more towards you are an attending now. You can't have any other IRA balances, right? You don't want that SEP IRA. Simple IRAs are not all that common anymore, but you don't want a simple IRA, and you can't have any other IRA balances besides the one that you're converting over, right? So keep that in mind. The SEP IRA is usually the sticky one because if you had 1099 income, it's not uncommon that maybe an accountant said, hey, just open up the SEP IRA. You can also look to do something then called a solo 401k plan and roll that SEP IRA into a solo K, assuming that you still have that 1099 income. And the beauty of the solo K is it allows you to still keep doing those backdoor Roths. But the reason why I bring up those income limits is depending on where you are, whether it's training or attending status, right? You can't just go directly to a Roth IRA if your income numbers are above that. And whether that's single or married filing jointly, the other tricky spot, married filing separately, a very common tax filing status for individuals with student loans. If you know, you know, right? So if you're going for public service loan forgiveness and you have another spouse with high income or really any income, you're likely looking at married filing separately at least most years. That plummets what you, the income limit to do direct Roth IRA contributions. So again, backdoor Roths become a lot more popular there. So in your training years, see if your employer plan has a match. If they have a match, take advantage of that. After you fill up the full match, so again, going back to my 3% example, and if you're sitting there saying, you know what, I think I have some more. I think I can do some more. That's where that Roth IRA could be your next stop. If you're watching this as an attending physician or a soon-to-be attending physician, in a lot of situations, I'm not going to say all because I know everyone's unique and there's always unique situations that pop up. You're at a minimum trying to always max out your 401k or 403b, doing a backdoor Roth IRA too, right? So you're maxing out that employer plan, maxing out the Roth IRA. After that, if you have that 457b plan, you might be coming back to that 457b plan for more pre-tax contributions. Again, that depends on a lot of situations, but especially in the academic space, where we say one of the better parts of academic medicine could be, you know, the amount of retirement accounts that you have. Now, even on the private practice side, while we may not see that 457b as common, then they might get in something called a defined benefit plan, where you're starting to see something called maybe a cash balance plan is very common. And there's other areas to put some more money in there as well. So a lot of different ways. We could, you know, literally spend hours on investing. This is just to kind of let you dip your toe into it. If you're watching this and you have student loans and you're going for public service loan forgiveness, one neat little way to lower your AGI, because remember, that's the number that's pulling in to your taxes, or excuse me, into your student loan calculation to actually tell you your payment. Anything you do pre-tax will help lower that number. In your training years, if you're not going for public service loan forgiveness, Roth contributions may make more sense. Because more than likely your income bracket is at lowest now that it's probably going to be for like the next few decades, right? Once you become an attending, it usually pivots immediately, where because of where your tax rate is, we're likely trying to do everything pre-tax, which is why that backdoor Roth starts to get really attractive. One of my favorite parts about the backdoor Roth IRA is it doesn't waste any pre-tax dollars. So that's why the backdoor Roth is such a neat little tool and something to keep in mind. You know, a quick Google search, whether you're on a YouTube or just looking through different blogs, you'll see a lot of details on that backdoor Roth IRA. And I know I noted earlier, but you know, feel free to send us questions as well. So investing 101, just dipping your toe in here. This can go a lot of different routes, especially where you are. You know, if you're watching this in your, 8, 9, 10 years of attending, you're probably saying, hey, I've already been doing those for a few years now. I started cranking away into a taxable brokerage account. I got money on to the 529 plans, thinking about doing some real estate investing. You know, it can go a lot of different ways here. So just giving you some high level numbers in there. All right, next up, insurance 101. So insurance, we're going to keep it high level here. We're not going to get into health insurance and car insurance and homeowners insurance. We're going to keep this on the personal side of things. So life insurance, disability insurance, I'm going to give you some bonus topics as well. So I'm going to pivot to the other side of the screen. Let's start with disability insurance. I would argue whether you're in training or anywhere in that early attending phase, disability insurance really, I mean, I could argue maybe more than health insurance, depending on the situation, is likely one of the most, if not the most vital insurance you need in your financial plan. And here's why I say that. Disability insurance ensures your ability to earn income, right? You just went to school for how many years? What's your current salary now? Just multiply that by, how many years are you working? 20, 30 years? We're talking millions upon millions of dollars. So that's why disability insurance is so good and so vital. And I didn't make my joke on the initial intro slide, but we put that little note down there on recommended by the White Coat Investor. And I say that because we don't sell any products. So I lead with that note here. This is truly for information purposes. You're not going to get invites to steak dinners on why we're going to sell you disability insurance. So we just want to give you what you should be looking for in terms of disability insurance. And there's two things you're going to see. There's a group plan, which you're usually going to see from your employer side, and there's private. Private is where you want to spend most of your time. Now, the group plans, fantastic. Take advantage of those. Your employer is going to pick up the bill there. A lot of times on these group plans, they might give you options to increase it a little bit. Usually with group plans, the main downside is, one, it's not the best definition of disability. The definition of disability is very important for physicians, especially physicians that use their hands more than others. So with that, when they don't give you the what we call true ONOC definition of disability, it is a little bit worrisome. That's why we'd rather have more private than group. And with those group plans, they're also taxable, right? Your employer's picking up the tab. They're getting a tax deduction to pick up the tab, right? It's great that they do that. But if you get paid out 10 grand per month from a group plan, it's still fully taxable. Private side is the exact opposite, right? You're paying those premiums out of your pocket with post-tax dollars. So when you get those benefits, they're completely tax-free. So use that same example, that 10 grand is actually 10 grand to you tax-free. With these policies, you're looking for true ONOC policies. You can see there we have 5 of them listed: Meritas, Standard, Berkshire Guardian, Principal, Ohio National. The one thing I want to update here, Ohio National no longer sells true ONOC policies anymore. The ones that they have out there are, and actually we should have replaced Ohio National with Mass Mutual. Mass Mutual is the other one. So we used to call them the Big 6. Now they're down to the Big 5. The one that's not listed on there is Mass Mutual, but Mass Mutual does have a true ONOC policy as well. So in the private plans, you're looking for that. Now, the second bullet point on there, that GSI, Guaranteed Standard Issue, that is one of the coolest things out there if you're still in training. So a lot of the training programs offer these guaranteed standard issue policies, and they're very unique. There's usually only one broker in the country that can offer to one medical school, or to one training program, I should say, where they can get these GSI policies. So if you're watching this and you're still in training, and train, again, whether that's your resident or even fellowship, you may have a chance to take advantage of a once-in-a-lifetime opportunity here. And the beauty of the GSI policy is twofold. The first fold, it benefits both males and females in the terms of no underwriting. With these policies, long as you were never denied from another large private policy, I should say large, really any private policy, you can apply to get this GSI policy. So no medical underwriting. So if you're worried about, Chad, I have this blemish here, I have this blemish here, don't worry about it. You're okay, as long as you were never denied on another application, which is a whole other story on why you need to be very careful on who you're applying for disability with. Because if you have option to this GSI policy, unfortunately, there are some brokers out there that if they can't sell that, they're going to punt on it regardless, because they want to get paid, right? And if they refer you to another specialist that only can sell this one policy, they don't get paid on it. So just be very careful. And if they don't do proper questioning and they apply somewhere for you and they did not disclose certain things and then you get denied, you're in a bad spot here. Not only were you denied from a private policy, you probably also, not probably, you just ruined your chance to get a GSI policy. So be very, very careful there. That's why we're very cautious with who is really pitching these policies. Medical schools and a lot of training programs have also gotten a lot better on being careful with who they let come in that was maybe selling products. So no underwriting questions, male or female. Here's the main draw, though, for female physicians. It's what we call a unisex policy. Most of them are still unisex policies. Unfortunately, we're going to see this continue to get phased out. But why is that important? Unfortunately, disability insurance is a lot more expensive for female physicians. So just keep an eye on that. That is why this GSI policy, if you're a female physician watching this video and you don't have a GSI policy, or even if you have another policy that's not a GSI, I would really look into this because this can be a huge money saver for you. And it's not only in your training years, right? You're going to keep this policy and you're going to build around it. A lot of them are around $5,000. They can get the whole way up to $7,500 now, and then they'll give you riders that you can add on as your income goes up. So male or female, check on that GSI policy. But if you are a female physician, that GSI policy should be very high on your radar. You're going to try to get as much as you can. Well, I know there's a question on this coming up towards the end too, but in a perfect world, you're looking to insure about 60 to 70% of your income. That's not a number that we make up. That is usually what these insurance companies are going to put in place for you. And you're looking to have as much as you can in private. Early on in your career, you want to fill this bucket as much as you can. Later on in your career, as you get closer to financial independence, maybe that number is lower. Maybe you can eventually drop this policy. And that's what I'll tell a lot of our clients. Ideally, we get to a spot where you're truly financially independent and we get rid of this policy. So disability, high on your radar. Next up, life insurance. Life insurance really depends on your situation. As I always say, if someone relies on your income, you likely need life insurance. Now, when we sit here, we're thinking, oh, well, I have a wife, I have kids at home. Of course, someone relies on my income, but it can also be further than that, right? Do you send money back home to help family? There's a lot of people that can be relying on your income. I'll use the example, did someone co-sign on your loans? I noted this earlier in the student loan section, but if someone co-signed on your loans, they could also be on the hook to pay that. You might want to get some life insurance. There's also, for whatever reason, when someone does rely on your income, physicians in particular will say, well, I'll just get like $1 million of coverage. And I'll say, well, is that a lot? Think about it, right? What's your salary now? What's that over 10 years, 20 years, 30 years? Okay, let's just try to replace your income. Millions of dollars. You want to pay off the mortgage? You want to send the kids to private school? Send them to the best college? A lot of money, right? So, we'll usually say, well, now we do a much more thorough analysis, but it should not make you fall out of your chair when we say $3 to $5 million of term life insurance should not be a large number. And in some situations, it might be more than that. In some situations, it could be lower. It could be none. But just keep that in mind. I know I put this note in here, term life insurance. You do not need permanent life insurance. There are very limited, almost non-existent examples of permanent life insurance in your younger years. And even in your later years, there is very unique circumstances. And it's usually because your actual net worth is so high that you're going to have to pay federal estate taxes. And the only reason then you're going to have life insurance is so that you can actually pay the tax bill because the federal estate tax bill is massive on a very massive number already. So you need term life insurance. You have group plans, you have private, same thing here. Beautiful side of term life insurance is it's transferable, right? You can change employers 100 times. You still get to keep your term life insurance. Now, group plans might be the only options for some of you. If you have some blemishes on your health record, these are usually pretty bad blemishes to be completely phased out of life insurance. A group plan might be your only option because group plans will give you group underwriting. So they're not worried about you per se. They're saying, hey, there's hundreds of physicians in that group or even 10 physicians in that group. We're going to give you a group plan, no underwriting. So life insurance, keep an eye on it. Shop term life insurance. And I put the note here. If you're in good health, you might even get cheaper plans on the private market than you even do in your group plans. Everyone thinks group plans are the cheapest. But depending on your health, you might be able to do better on the private market. Shop this around. This is one where as long as they have good financial ratings, I usually will make the joke, if they have a Super Bowl commercial, they probably have pretty good financial ratings. A lot of those bigger companies out there, right? The Prudentials, the MetLifes, the Principals, the Standards, those are all companies that have good insurance, and you can really shop that, right? You can kind of spreadsheet them and see the lowest one on there. Be careful, every now and then you'll see like Uncle Joe's Insurance Company, lowest premium on there, and then you kind of look at their financial rating and you're like, Uncle Joe's Insurance Company is probably not going to be around. Heaven forbid I need to actually cash in this policy, right? Or my family needs to cash in this policy. They're probably not going to be around because things don't look too good. So just be careful with that. Make sure they have a good financial rating. A good independent insurance broker can help you shop those around. Other things to keep in mind in just overall, I'll call this even more risk management as opposed to insurance. HSA, a health savings account. One of my favorite accounts. I usually joke right behind the Roth IRA, HSA is one of my favorite accounts. The key to the HSA is, though, you have to be using a high deductible health plan that's HSA eligible. So if you check those boxes, the HSA is a place that you can put money into. That number varies per year. There is a family number, then an individual number, but you can put money in there, tax deduction going in. So again, high income physicians, we love pre-tax deductions. HSA is one of those. Now, a lot of these plans allow you to invest the funds. It doesn't mean you have to invest it, right? If you decide to keep it in cash for whatever reason, you might want to do that. But you can also invest the funds, let them grow for many decades. And then later in life, when we're all much older and our healthcare costs are going up, you have this beautiful nest egg for health costs. HSAs have a lot of neat factors to them. You can save receipts and actually pull lump sums out tax-free. There's a way to utilize, we call it the stealth IRA after age 65. So there's a lot of neat things that you can do with the HSA, but the key is you have to be utilizing a high deductible health plan that's HSA eligible. Another one of those topics, keep it on your radar, depending on where you are right now, kind of dig into that more. But HSAs are usually pretty high on our, what we call, our waterfall per se on what we're looking at. If an HSA makes sense for you, it is a really neat tool, not only today, but as you go forward. Another neat one, flexible spending accounts. You have the healthcare side. You also have the dependent care. Keep in mind, dependent care, not only for kiddos, but it can also be for other loved ones, for our parents. So downside to FSAs is the money is not guaranteed to roll over, right? So if you put $2,000 into the FSA for childcare, but you forgot to write the check to the childcare provider, and you get past the end of the year, or sometimes they'll give you a little bit of a phase-out window earlier into the next year, that money could truly expire. So you could actually lose that $2,000 in that example. Sometimes they're adding better flexibility, and then they might say, hey, $500 can roll over, and same thing goes with the healthcare FSA. So another pre-tax benefit, really good thing to keep in mind, but just be careful there. Make sure you understand the moving parts of the FSA. Your open enrollment packet should give you good context there. If not, have a conversation with HR or your financial advisor, and they should be able to dig into that for you. The last three here are, I would not label these as insurance per se, but more or less thinking of risk management and even asset protection for our physicians. Low-hanging fruit, umbrella insurance. If you've never heard of umbrella insurance, it is an easy way to add an extra liability coverage. Personal liability. This is not medical malpractice, but this is personal liability. And they call it umbrella because it sits over top of your home and your auto. So they gave it this cool name of the umbrella, right? So it's extra liability on your home and auto. Usually we'll say try to cover your net worth and don't be scared to round up. Umbrella insurance is relatively cheap in really all parts of the country. I pause there because our plan used to be much cheaper in Pennsylvania than it is in Florida. So every state will have its own differences. But back when I was in the Northeast, I'd say about $1 million of coverage, probably around $300 per year. So $1 million of extra liability, $300 per year. Down in Florida, it essentially doubled for us. Same thing about $1 million, but it's about $600 per year for that extra liability insurance. Unfortunately, as a physician, you get an extra target on your back. It stinks to say that, but it's true. If you get into a car accident, they get any type of legal counsel that's decent at a Google search. They find out, well, it's not Mr. Smith or Mrs. Smith, it's Dr. Smith. I call it my soccer flop. They roll down, right? They're screaming a lot more. They're yelling. They're bringing out their own phone at that point. Video, it gets bad, right? You got that target on your back. So umbrella insurance, good, easy liability coverage. As your net worth increases, increase your liability. Fun fact too, if you have kids or plan to have kids and your kids get closer to driving age, at 16 to about 24, a lot of companies won't even sell you umbrella insurance or they won't allow you to increase it. So word for the wise, keep an eye on that. General asset protection. Asset protection is one of those terms that physicians love, and you should, right? Again, I use the target, not only on the personal side, but also on the medical malpractice side. But asset protection, just making sure you understand your state's rules. Asset protection is actually a lot more important to the state level than it is the national level per se. For example, I keep saying this taxable brokerage account. Well, there's 18 states, I believe it's 18, I always pause when I say 18, that allow a joint investment account with your spouse. And it's called tenants by the entirety or tenants in the entirety. All it is an account title on a joint brokerage account, but it has unlimited asset protection. Now, you have to be in one of the states that offer it, but it's a common error we see from a lot of DIY physicians that do their own financial planning or their own investment management, I say, where they will go open the account as joint with rights of survivorship because that's the most common title to open it. where we'll look at it, we'll say, but you're in the state of Florida, and we have tenants by the entirety here. Let's update that account title because you get good asset protection. Your employer plans, 401ks, 403bs, they're protected by ERISA. That is pretty much ironclad. You could have one of the worst medical malpractice lawsuits of all time, ironclad. They can't get through that thing. And every state will have its own rules. Most states protect IRAs and Roth IRAs really, really well. You still have to understand your state's rules. Clients will get into trust planning. They usually will say trust planning is probably later down the road because revocable trusts are very common early on, but revocable trusts don't do anything for asset protection. It's the irrevocable trusts that are much stronger for asset protection, but that usually comes much later down the road and usually with a much higher net worth number. So asset protection, very important at every phase of your career as a physician. Heck, if I was doing this presentation to teachers, I would still say like umbrella insurance, the tenants by the entirety, because it doesn't matter whether you're a physician or not, right? Even just driving down the road, there's that possibility of something bad happening. And then last but not least on this one is state documents. We brag that most of our clients will have their estate documents done before their parents. Unfortunately, sometimes before their grandparents. And at a very simple level, you don't have to get crazy here, at least earlier on in your career, but you need to have a will. You need to have a living will. You need to have a healthcare power of attorney. You need to have a financial power of attorney. And in most states, you're probably going to have what we call a revocable trust. I know I noted that earlier, which it kind of replaces the will for the most part. It's going to have the context in there. Now, whether that's two individual revocable trust or a joint revocable trust, we'll leave that up to your attorney because I am not an attorney. Do not take legal advice from me, but we can at least give you some ideas and some things to keep in mind as you walk through your financial planning journey. So that is our Insurance 101. This is one of my favorite note cards. I wrote this thing probably about 10 years ago now, and I use it in more presentations than you would know. Actually, pretty much all my presentations, I have it on there. And this is one that if you take this and run with it, and I don't see it for 5-10 years, you should be in a pretty good spot. I'm very confident of that. So first and foremost, avoid flashy investments. Boring and average is all you need with good savings habits, or what I like to say, get in the habit of saving. Low cost, diversified, biggest factor, control your emotions. And with investing, start sooner than later. The most powerful tool in all of finance, compounded interest. It's not a magical sauce. It's not buying the most recent meme stock and hoping that it works. It's just consistency, time in the market with that compounded interest. Your saving habits matter the most. Don't interrupt it. You likely don't need permanent life insurance. I always joke that I'm going to remove this and just say you remove. Likely, you don't need permanent life insurance. Disability insurance is the most, very high on the list, one of the most, if not the most important insurance you need right now, especially earlier on in your career, because you have a lot of earnings in front of you. Buy an umbrella policy, extra liability protection. Asset protection is key. Qualified accounts. When I say qualified accounts, just think your 401k, your 403b. Again, ERISA's protecting that. Understand your state's rules. If you have that joint account, now remember, tenants by the entirety, or sometimes called tenants in the entirety, that's the one you're looking for. That's the key there. Maxing out that 401k, 403b, maxing out that backdoor Roth, getting money into that taxable account I have over there on the side, staying tax efficient. There's only so much time we can put in these presentations, but in a taxable account, you are trying to build that in a more tax-efficient manner. And then last but not least, physicians more than anyone know the vitalness of that work-life balance. So love thyself, love your family, takes breaks to avoid burnout. If you can follow those, you should be in a pretty good spot. I'm very confident of that. After doing this now for over 12 years, I can say that if you've been following those rules, you'll be in a good spot. So I'll pause here. We'll head over to our question segment next. We'll walk through some great questions. And like I said, if you have any other questions, please send them our way. We'll be happy to answer those for you.
Thank you so much, Chad. That was really, really informative. I learned so much. So I just have a couple follow-up questions for you. The first question is for disability insurance, how much do you believe is enough?
Yeah, and I know we walked through this a little bit towards that last slide on the Insurance 101. The key here is earlier on in your career, you're trying to fill up this bucket as much as you can. And the number is set by the insurance industry, and most of those insurance providers are going to cap you out around 60 to 70% of your income. So earlier on in your career, this is one of those non-negotiables. You're trying to get as much as you can. more on the private side if possible, because that's just going to be a stronger, more controlled definition of what we call true own-occ. Later on in your career, you might be able to lower this number. You might be able to drop it all together, which is really one of those great things. It usually means you've hit financial independence, and heaven forbid you can't go back to work again. It's okay. It won't throw your financial plan into this loop. So 60 to 70%, or the short answer is as much as the insurance industry will allow you to get.
Understood. So what about life insurance? How much is enough for that?
Yeah, and this is another one where this one is more situational based than disability, right? Disability is one of those ones where I can say get as much as you can. Life insurance is going to really be dependent on how much someone is relying on your income. Now, if no one's relying on your income, you might not need any. Now, you might want to get some for different reasons, just because of personal reasons, but if you do have someone relying on your income, that's the one that I noted again in that last slide there in terms of don't think $1 million is a lot of money. If you're just doing a checklist and you're going to say, all right, well, what if I can't work for 10, 20, 30 years? How much just to replace my income, right? I just did all this schooling. I did all this work. I want to at least make sure my family gets, my future earnings. Hey, I want to pay off the mortgage. I want to get my kids through K through 12 private school and then any college that they can dream of. As soon as you start adding these numbers together, we're talking million. I mean, just your income alone, we're talking millions. So working with a good independent broker or your financial planner, you should be able to get a very detailed number in there. And that number still is variable, right? It's going to change as life throws us curveballs, course corrections in there. But, $3 to $5 million as a starting point in a physician household should not sound like a large number.
Got it. So for a new urologist, let's say just a couple of years out of residency, and they're looking to purchase a home, how do you think they should determine their price range?
Yeah, a fantastic question. I was actually happy I got this one in advance too, because I could actually add some more context to it. So if you come to us for a financial plan, the number we've always used, and this is actually from the CFP board, they always say you never want to use more than 28% of your income on housing. Now, after building these for over 12 years now, I would say that 28% is a very high number. Our average client is actually almost half of that number. But let me just add some numbers to it so we can show you why 28 is probably a little bit high. Now, the caveat here is it also depends on what part of the country. I know I've said this earlier too. Is it New York or is it Iowa, right? Is it a Missouri versus a Southern California? My joke was I always thought the Northeast was very expensive, and then we got clients in Southern California. That housing market's a whole different world. But regardless, 28 should be your absolute max. And again, I say this with a big hug included in it. I hope that you're actually much lower than that number. And to add context to it, let's just say household income is $500,000. So 500,000, maybe it's a dual physician household, maybe it's a urologist is doing very good. At 28%, that would be about $140,000 per year in housing. That's almost $12,000 per month. Now I'm going to plug in an escrow number in there, and let's just say the actual principal and interest. So if you're new to home buying, right, usually your payment includes your principal, your interest, that's your true mortgage payment. And then you're going to have escrow, and escrow is just you prepaying those property taxes and also your homeowner's insurance, but most of that's coming through your property taxes. So if we just use a 7% interest rate and we say the principal and interest payment is $10,000 per month, at those rates, that's a $1.5 million home. So I hope most of you listening to this saying, well, household income at $500,000, $1.5 million, and not even a home, that's just the mortgage, right? Who knows what you put down on the down payment. Hopefully a lot of you are saying, that sounds like a lot. And that's my point I'm trying to make. I would say that seems like a lot. And if we would take the other side of that argument and we say, well, what does 14% look like? Again, using a lot of the same numbers, 7%, but let's just say that we cut that in half. So the actual principal and interest payment is $5,000. That's about a $750,000 home. When we build plans, that number would make me feel a lot more warm and fuzzy inside, because the problem with buying a home is that's a big purchase, right? It's not something that you can quickly pivot out of. So these types of decisions, especially earlier on in your career, are so pivotal for your cash flow and even your discretionary income as you go forward. And even keep in mind, what's family planning goals when it's just you and your significant other. Think I got all this extra money. This is great. I'm going to go buy a big house. But all of a sudden you plug in a kid or two. We got to plug in, we got to feed them, right? They're expensive little buggers. Then they got to go to private school. And all of a sudden life catches up really quick. And you're still in that home that at one point felt like you had a lot of wiggle room. But all of a sudden it's getting a lot tighter in there. So that was a very long-winded answer to 28% is what the rule book says. That number is way too high. I'd be aiming more for that 14, but understanding, depending on where you are in the country, it could sneak up a little bit higher.
Wow, really, really good to know. So I know you talked a little bit about this in your talk. Outside of the typical savings vehicles, like 401k, Roth IRA, HSA, brokerage, etc., do you recommend clients look into real estate or CDs or any alternatives?
Yeah, another fantastic question. I think that the real estate community in particular is bombarded with real estate investing because we sit there as a very busy physician. You're like, wow, passive income sounds really nice right now. There's pros and cons that come with real estate. We do like real estate. We like real estate with direct ownership. So not as much as like a syndication per se, but clients actually buying their own rental properties. Now I always make the joke, it's anything but passive. It still requires a lot of work. Even with a property manager, there's still a lot of work in there. But real estate is a popular investment tool, especially once we go through the foundations, right? We're maxing out the 401k. We're doing the backdoor Roth IRA. We're cranking money into the taxable account. We got the 529 plans going for the kids. Now what? Real estate is another common one in there. We love when our clients have opportunities to buy into their practice, right? Whether that's partnership, whether that's a surgery center, maybe that's the real estate of the buildings. We really like that type of investment vehicle too. And I know you noted CDs and treasuries and things of that nature. Usually we think of that as cash alternatives. And that would be more towards like the side of, hey, it's our emergency fund, but maybe we're just getting a little bit better yield than what the high yield savings was giving us. So we do like to diversify outside of it. Now, with that said, it doesn't mean you have to, right? You could have $5-10 million and all you have is a couple beautiful index ETF portfolios. That's okay. And that's one that we usually say as our physicians continue to grow net worth. You don't have to make it more complicated. So just always keep that in mind. But definitely other forms of diversification for sure.
Awesome. So are there any mistakes that you see typically in a first employment contract?
Yeah, I'd say from our side of it, the most common mistake is not having an attorney review it. That's the one where, especially the first one, I'll usually say that on that first contract, it's so important because it sets the bar for every contract after that. So have an attorney review that, actually checking out the MGMA data, making sure you're being paid a fair number for not only your specialty, but for that area. Those are really important numbers. Understanding, your non-compete. I know there's a lot of chatter out there on hopefully those going away. I could not agree more. Hopefully they would. But for now, you still need to understand all the restrictive covenants that can be in a contract, all the moving parts. What's your balance of call versus off and who's covering for you in those situations. There's a lot of detail in there that you want a good qualified attorney, in particular a physician contract attorney, right? Sometimes we get nervous. We're like, well, my friend does real estate law and he said he can review it. And while I'm not saying he can't or she can't, we want someone that's very well versed in understanding all the very specific parts that comes with a physician contract. So the easiest answer is make sure you actually have an attorney review, not only your first contract, but I would argue every single contract going forward.
Awesome. So how do you determine the right amount to save for retirement?
Yeah, another one where you try not to use the broad stroke of the brush, but this is very detailed. Say our plan builds usually take about 2 months, right? So there's a lot of information that we're collecting before we even get to a point where you should be saving X. But if we're hanging out together and you say, hey, I think you're a CFP, how much should I be saving? For most physicians, because you do get a little bit later start, we're usually saying 15 to 20%. Does it always work out that way? It doesn't. Sometimes clients are going to be lower than that. Some are going to be higher than that. That is a traditionally good sweet spot in there. And that can include a lot of things, right? Ideally, your retirement plan at work, your backdoor Roth, your taxable account. Maybe you're getting just consistent savings into a high yield savings because you have other goals. That all counts towards savings. But getting somewhere in that 15 to 20% range is a fair billboard number, but there's a lot of details to probably confirm that number. But again, physicians a little bit later start there. So that's why we're going to be a little bit higher than the Google answer per se.
Got it. So my last question for you is, and you talked about it a little in your talk, what are some specific financial pitfalls that you think that a new urologist should definitely avoid?
Yeah, and, the note card probably does a good job there, but I added some more details in here. Now, this one was on the note card, but I put not enough disability insurance. I think that, especially early on in your career, that is one that you have to really hammer down. You got to have a good number in there. It's just one of those ones where you got to be proactive. That is one you cannot be reactive on. Too much car, too much home. I should probably say it the opposite way. Too much home, too much car. But too much home is really a difficult spot, not only in your budget today, but also going forward. And same thing with a car. And we're not anti-fancy car. That's fantastic. I'm not a car guy myself, but for those of you that are, your day will come. There will be the day to get the fancy car and maybe numerous fancy cars, but especially early on in your career, just be careful not to go down, hey, I need the newest Porsche or the newest Tesla out there. And there's so many things that we could plug in there, but just be careful there. I use the air quotes on, I'll start investing later. Start now. You don't have to go max everything out, right? In a perfect world, sure. As an attending physician, I hope you are maxing out a lot of those. But just get started. Don't say, I'm going to do this first, or I want to get this paid off and then this paid off, then this. Even if it's just a little bit, start to set those habits, because your most powerful tool is compounded interest. And then the last one I add on here is, I think we could probably make this a speech to all Americans, right? But especially physicians, in terms of work-life balance. Build that in now. Understand it earlier on in your career. I know it's a little bit harder earlier in your career because you don't have that seniority yet, but understanding that work-life balance, or the times that you are out of the hospital, out of the practice, finding ways to disconnect and just kind of give you some reprieve. Because if you want to be a world-class doctor, we need you around more than a few years, right? We need you to make this a true long-term event, and that work-life balance is so important for everyone, but in particular for physicians. So we'll end it on that one, on just making sure you're really, really paying attention to that work-life balance.
Wonderful. Thank you so much. This was amazing. I've learned so much, and I look forward to continuing this conversation.
Thank you.